The thrusting line pattern is a bearish continuation pattern observed in the stock market, indicating that the current downtrend is likely to continue. It shares similarities with the on-neckline and in-neckline patterns, each having unique criteria and implications for market movement. The on-neckline pattern occurs during a downtrend when a long black candle is followed by a small white candle. The white candle's close is just slightly above the close of the black candle, suggesting that the downtrend might resume soon. This pattern indicates that despite a brief respite, selling pressure remains strong. The in-neckline pattern, similar to the on-neckline, also appears during a downtrend. It involves a long black candle followed by a small white candle. However, the difference lies in the closing level of the white candle, which closes slightly into the body of the black candle, but not high enough to suggest a significant reversal. It implies that the market may briefly stall before continuing its previous downtrend. Understanding these nuanced differences is crucial for traders and investors to accurately interpret bearish continuation signals and predict the most probable market direction. While all three patterns suggest a continuation of the prevailing downtrend, recognizing the specific pattern can provide insights into the strength of the bearish sentiment and the immediacy of the continuation. The upside gap 2 crows is a bearish reversal pattern that emerges at the peak of an uptrend, suggesting a possible shift towards a downtrend. It unfolds over 3 days and is recognized by a distinct sequence of candlestick formations, signaling a weakening in bullish momentum. On the first day, a long white candle appears, consistent with the prevailing uptrend. The following day opens with a gap above the previous day's close, but it concludes with a black candle that closes within the body of the day 1 candle without surpassing its low. The third day mirrors the second, with another black candle opening above the body of the first day, but closing further within its range. This pattern collectively suggests that despite initial bullish sentiment, sellers are beginning to take control, potentially leading to a reversal of the trend. This information serves as a heads-up for traders and investors, signaling them to consider readjusting their strategies. The upside gap 2 crows is a bearish reversal pattern that can be identified in the stock market by looking for a specific sequence of candlesticks on a chart. Initially, this pattern starts with a long white or green candle, which signals strong buying pressure and is typically seen as a bullish indicator. The story takes a turn the next day when the market opens higher than the previous close, creating a gap. This is followed by 2 smaller black or red candles. These smaller candles open within the body of the previous candle, but crucially close within the body of the first long candle. This visual creates the appearance of 2 crows sitting on the first candle, hence the name of the pattern. This formation signifies that despite the initial bullish sentiment, bearish traders have gained control and pushed the prices down, warning of a potential reversal in the trend from upward to downward. Understanding this pattern can be a valuable tool for investors, signaling the right time to reassess their positions in anticipation of a possible market downturn. The upside gap 2 crows pattern is a clear indicator of a shift in market sentiment from bullish to bearish. Initially, the market shows a gap up, which is a sign of strong bullish optimism, suggesting that investors are feeling positive and are buying, pushing the prices higher. However, this optimism does not last, and the scenario quickly changes. Despite the initial upward gap, bearish pressure mounts as the market fails to maintain these higher prices. Over the next 2 days, prices close lower, which contradicts the initial bullish sentiment. This sequence of events signals to investors that the market's mood is changing and caution is advised. The appearance of this pattern alerts investors to the potential end of an upward trend and the beginning of a downward shift in the market, highlighting the importance of being attentive to such patterns for making informed investment decisions. The upside gap 2 crows is identified as a bearish reversal pattern, signifying a potential shift in market sentiment from bullish to bearish. It emerges within the context of an upward trend, indicating that while the market has been moving upwards, there is a growing strength among sellers, hinting at a possible change in direction. This pattern consists of 3 significant components. Firstly, it begins with a long white or green candle, characteristic of the existing uptrend. This candle is followed by a gap up. However, instead of continuing the upward momentum, the market opens higher but closes lower for the day. This results in a small black or red candle, which does not close the gap and provides the first hint of bearish sentiment. The third component is another black or red candle that opens within the body of the second day's candle and closes within the range of the first day's candle, further confirming the bearish outlook and suggesting a weakening in the prevailing uptrend. Understanding this pattern helps investors and traders recognize moments when the momentum might be shifting from buying to selling pressure, thereby aiding in making more informed decisions about entering or exiting positions. It's crucial for those analyzing the market to look for confirmatory signals following the appearance of this pattern to gauge the strength and potential duration of the impending bearish movement. To understand how volume plays a role in confirming the upside gap 2 crows pattern as a bearish reversal, it's important to start with what this pattern is. The upside gap 2 crows is a bearish reversal pattern seen in candlestick charts, a type of financial chart used to describe price movements of a security, derivative, or currency. This pattern forms after an uptrend and signals a potential reversal in the market. Key to confirming this pattern's validity is an increase in trade volume during its formation, particularly during the appearance of the 2 crows, which are represented by 2 bearish or downward trending candlesticks. An increase in volume suggests that selling pressure is mounting, thereby providing stronger evidence that bearish sentiment is taking hold among investors. Further confirmation can come from additional bearish candlesticks following the 2 crows. This continuation of bearish indicators reinforces the likelihood of a downward trend. Another form of confirmation is a breakdown below support levels. Support levels are prices at which an asset tends to stop falling because demand increases as the price decreases. A breakdown below these levels indicates that the price is likely to continue falling, confirming the bearish reversal signaled by the upside gap 2 crows pattern. In sum, the upside gap 2 crows pattern, when accompanied by increased volume and other bearish indicators, can alert investors to a possible shift from an uptrend to a downtrend. These confirmatory factors are crucial for investors who rely on technical analysis to make educated guesses about future market movements. The upside gap 2 crows pattern is a signal in chart analysis that hints at a potential bearish reversal, meaning that it could indicate the end of an uptrend and the beginning of a downtrend in the market. While this pattern alone provides a strong hint towards a possible shift in market direction, its predictive power improves significantly when it is analyzed in conjunction with other technical indicators. Two notable indicators that can enhance the reliability of the upside gap two crows pattern are the relative strength index, or RSI, divergences, and the moving average convergence divergence, or MACD, bearish crossovers. RSI divergences occur when the price of a security is making new highs while the RSI fails to surpass its previous highs, indicating weakness in the trend. On the other hand, a MACD bearish crossover happens when the MACD line crosses below the signal line, suggesting a potential decrease in momentum and a likely downturn in price. By observing these indicators alongside the upside gap two crows pattern, analysts can gain a more comprehensive understanding of the market's condition and make more informed predictions about future price movements. In short, the combination of the upside gap two crows pattern with RSI divergences and MACD bearish crossovers can provide a clearer and more reliable indication of a potential shift from bullish to bearish market sentiment. This integrated approach helps in making better informed trading decisions by not relying on a single pattern or indicator, but rather assessing a confluence of signals. To augment the reversal signal indicated by the upside gap two crows pattern, traders enlist several other technical analysis tools. They observe the relative strength index, commonly known as RSI, to check for overbought conditions. An RSI reading above 70 frequently signals that an asset is overbought, thereby supporting the bearish reversal suggested by the upside gap two crows pattern. In addition to RSI, traders use the moving average convergence divergence, or MACD, to validate momentum shifts that align with the anticipated reversal. The MACD helps in spotting changes in momentum by comparing two moving averages, and a move from positive to negative or a bearish crossover can confirm a potential downtrend. Lastly, identifying critical support levels plays a crucial role. If these levels are breached following the appearance of the upside gap two crows pattern, it further substantiates the bearish reversal. In essence, the breaking of key support levels indicates that the price is moving lower and the downtrend might continue. By integrating these tools, traders can reinforce their confidence in the reversal signal provided by the upside gap two crows pattern, enabling a more informed investment decision. A common mistake when analyzing the upside gap two crows pattern is acting without awaiting further confirmation, which can lead to premature entry into bearish positions. It is essential to wait for additional market day following the appearance of this pattern before making a decision. This approach helps in validating whether a true bearish reversal is imminent. Additionally, it is crucial to accurately identify the upside gap two crows pattern and differentiate it from similar formations that may not indicate a reversal. This involves careful examination of the pattern's specific characteristics, such as the initial upward gap followed by 2 days of downward price movement within the range of the first day's high. Understanding these subtleties can prevent misinterpretations and potentially costly errors in trading strategies. Upon identifying an upside gap two crows pattern, traders might interpret this as a potential signal for a shift in market sentiment from bullish to bearish. This pattern can serve as a cue for traders to consider taking short positions, which means they might sell an asset expecting its value to decrease, or to exit long positions where they have previously bought with the expectation of a price increase. The pattern typically requires further bearish confirmation before it is acted upon. This means traders look for additional signs that the market is likely to continue in a downward trend before making their move. Identifying an entry point involves waiting for this confirmation following the appearance of the upside gap 2 crows pattern. To mitigate risk and manage potential losses, traders often set their exit points or stop loss orders above the highest point of the pattern. A stop loss order is an instruction to sell a security when it reaches a certain price, helping traders to limit their losses. By placing the stop loss order above the high of the pattern, traders can cut their losses should the market not move in the anticipated downward direction after all. In summary, the upside gap 2 crows pattern can alert traders to the possibility of a bearish market reversal. Strategic responses involve entering short positions upon additional confirmations of market downturns and carefully setting exit strategies to manage risks effectively.